There's a line on your tax return that almost no one pays attention to. It looks harmless, just a number quietly sitting there on your 1040. But last year, that one line triggered surprise taxes, spiked Medicare premiums, and wrecked thousands of retirement plans without warning. And the worst part? Most retirees never saw it coming. They followed the rules. They did what their advisors told them. They thought retirement meant lower taxes and fewer headaches. But hidden deep in the tax code is a calculation so quietly destructive it's cost retirees thousands, even when they thought everything was under control. This isn't a loophole or a scam. It's built into the system, a legal mechanism that treats certain types of income in ways you'd never expect, and the consequences don't show up until it's too late to fix them. Today, we're pulling back the curtain on the one line that could quietly unravel your entire retirement strategy and the 7 overlooked mistakes that make it even worse. If you think the IRS is done with you once you stop working, think again. When Social Security was first created, it wasn't taxed at all. Every dollar you received was yours to keep. But that changed in the 1980s, and now up to 85% of your Social Security benefits can be taxed depending on your income. It all hinges on something called combined income. That's your adjusted gross income plus non-taxable interest plus half of your Social Security. If that number crosses $25,000 for single filers or $32,000 for married couples, you start owing tax on a portion of your benefits. And once you hit $34,000 or $44,000, the IRS can tax up to 85% of your benefits. Not at 85% tax, but 85% of the benefit becomes taxable income. Still, for many retirees who thought Social Security would be their safe stream of income, it's a gut punch. Because the surprise doesn't come in the mail. It comes in April when your tax bill suddenly looks higher than expected and no one explains why. You didn't make a mistake. You didn't do anything wrong. You just earned more than the system secretly allows, and your Social Security got pulled into the crossfire. Most retirees think they're safe if their income comes from tax-free sources like Roth conversions, municipal bonds, or health savings account reimbursements. But here's the twist. Even though this income might not be taxed directly, it can still count toward the formula that determines whether your Social Security gets taxed. It's what financial planners call phantom income. You don't see it on a paycheck. You don't owe tax on it up front, but it still gets tallied into your combined income, the number that decides how much of your Social Security becomes taxable. Take municipal bonds, for example. The interest might be tax-exempt on the federal level, but the IRS still includes it in the Social Security tax formula. Same with Roth conversions. Even though it's strategic in the long term, the year you convert, the amount shows up as income. Suddenly, your smart, tax-free moves are quietly inflating your income behind the scenes, triggering taxes you didn't expect, and dragging more of your benefits into the taxable zone. Most retirees never see it coming because nothing about these moves feels taxable. But once the IRS runs the math, the damage is done, and you're stuck paying for income you thought you didn't have. Most people don't realize that one small bump in income can come with a big, delayed punishment, not from the IRS, but from Medicare. If your modified adjusted gross income crosses certain thresholds, you're hit with something called IRMA, the Income-Related Monthly Adjustment Amount. It sounds technical, but here's what it means in plain English. Your Medicare Part B and Part D premiums go up, sometimes by hundreds of dollars per month, just because you earn slightly more than the government wanted you to. And here's the kicker. The penalty isn't immediate. It often shows up a year later, long after the tax return that triggered it. So let's say you did a one-time Roth conversion, or sold a stock, or took a big RMD. You didn't think much of it. Maybe you even planned for the taxes. But what you didn't plan for was Medicare quietly recalculating your premiums behind the scenes. $1 over the line can push you into a higher bracket. And once you're in, you're stuck there for the full year. No warnings, no flexibility, just a higher monthly bill, and no one tells you why. This isn't just a tax problem anymore. It's a retirement budget problem. And it's all because of a number buried deep in your tax return, a number that most people never even check. There's a moment in retirement that catches many people off guard. The year you're forced to start taking required minimum distributions or RMDs. Once you hit age 73, the IRS requires you to start pulling money out of your traditional IRA or 401k, whether you need it or not. And here's where things get messy. Those RMDs are counted as ordinary income. They show up on your tax return, inflate your adjusted gross income, and you guessed it, push your Social Security into the taxable zone. For retirees who've spent decades deferring taxes, this is the trap. They've built up large retirement accounts, thinking they'll pay less later. But later arrives with a tax bill that's higher than they ever expected. And it doesn't stop there. That spike in income can also push you into IRMA territory, the Medicare penalty zone. So not only are you paying more in taxes, you're also paying more for healthcare. All because of money you didn't even choose to take. RMDs aren't optional, but how and when you plan for them makes a massive difference. And for those who ignore it until the IRS sends a letter, it's often too late to soften the blow. What felt like smart saving turns into a tax-triggering time bomb, and the fuse is lit the moment you cross that retirement age threshold. Everyone tells you that retirement means you will be in a lower tax bracket. Less income, fewer expenses, simpler finances, right? But here's the problem. For many retirees, that assumption turns out to be completely wrong. Between Social Security, pensions, investment income, and required minimum distributions, your taxable income might be just as high, or even higher, than it was while you were working. And because retirement income often stacks all at once, it can actually push you into a new bracket without you realizing it. The worst part? Most people don't see it coming until they're already in it. They delayed withdrawals, held off on converting to Roth, and skipped tax planning, all under the belief that their income would be lower later. But when later arrives, the system piles everything on at once. Your Social Security gets taxed, your Medicare premiums spike, your portfolio withdrawals become less efficient, and all of it stems from a fundamental misunderstanding. The idea that taxes automatically go down just because you stop working. The truth? In retirement, tax planning doesn't get easier, it gets more important. And the retirees who ignore that usually find out the hard way, buried in paperwork and surprise bills they were never warned about. For decades, you've been told to defer taxes, put money into your 401k, max out your IRA, let it grow, and worry about taxes later. But here's the trap. Later eventually shows up. And if you've deferred too much for too long, the bill comes due all at once. The idea sounds smart at first. Lower your taxable income now, pay taxes when you're older and presumably in a lower bracket. But for many retirees, that bracket isn't lower, it's higher. Especially once required minimum distributions kick in and stack on top of Social Security, pensions, and investment income. Suddenly, that big, beautiful IRA becomes a tax magnet. And every dollar you pull out gets taxed at your highest marginal rate. Not only does that shrink your income, it also triggers more taxes on your Social Security and can bump your Medicare premiums through the roof. That's why strategic Roth conversions in your 60s, before RMDs begin, can be a game changer. By gradually moving money into a tax-free account, you reduce the size of your taxable nest egg and take control of your future income stream. But most people miss this window. They defer and defer, just like they were told, until it's too late. Then they find themselves paying more in retirement than they ever did while working, all because later was never part of the real plan. Buried in the middle of your tax return is a simple line, line 6 on the 1040. It reports how much of your Social Security is taxable. But here's the catch. By the time that number shows up, the damage is already done. There's no warning, no red flag, no alert that says, hey, your benefits are about to be taxed at 85%. It just appears, quietly, after the IRS has run its formula behind the scenes. Tax software won't explain it. Most CPAs won't mention it unless you ask. And the IRS certainly doesn't send a letter saying, you could have avoided this. That's what makes it so dangerous. Retirees don't realize what's happening until they get hit with a bigger-than-expected tax bill and higher Medicare premiums and a domino effect they can't undo, all from a single number. One calculation, one overlooked detail on a return most people barely glance at before signing. By the time you see that your Social Security is being taxed, you're not just looking at a bigger bill, you're looking at a missed opportunity. Because this wasn't a one-time mistake. It's a recurring cost built into your retirement now, every year from here on out. Retirement isn't just about saving enough, it's about keeping what you've saved. And the truth is, one overlooked line on your 1040 can quietly drain your income year after year, without any alarms going off. No flashing warnings, no alerts. Just a number that quietly triggers taxes, penalties, and higher costs you never planned for. The scariest part? You didn't do anything wrong. You followed the rules. You made smart choices. But the system is built to collect, not to protect. And unless you understand how these numbers connect, the retirement you spent decades building can unravel faster than you ever expected. Now you know. You know how Social Security gets taxed, how Medicare premiums spike without warning, how RMDs, phantom income, and safe withdrawals can all backfire if you don't plan ahead. This isn't about panic, it's about power. Because once you see the trap, you can avoid it. You can take back control. And most importantly, you can build a retirement plan that works for you, not just for the IRS.